Jamie, you've been a realtor for 16 years?
Since 2008. Can't do the math.
15?
Sounds like 15.
15 years?
Yeah, let's round up. It's 16.
Have you ever seen consumers pay so much attention to Bank of Canada rate announcements?
No. I've never seen everyone pay that. Like realtors become experts in the financial monetary world.
Totally. It's kind of crazy to see how, and real estate markets change every year, month to month. And it's kind of crazy to see how the market has like just adjusted based on when rate announcements happen. And, you know, I can't, if you asked me 2 years ago, how many Bank of Canada meetings are there in a year? I would have had no clue. I don't know if it's one. I don't know if it's once a month. No idea. But we just had another one, middle of October. And for the second straight meeting, they held the rate. So prime remains at 7.2. It's interesting to see the activity on listings adjust based on where these rate announcements are happening. And even just, I'd say in the last like 3 or 4 meetings after those like 2 summer hikes, whatever the months were, maybe May and July or June and July or something like that. After those 2 hikes, it seems like consumers, both buyers and sellers, are super focused on what is going to happen at the next one. And this is something we were talking about a couple days ago, but timing your listing around these Bank of Canada announcements has become important. That, you know, we talk all the time about like you can't time real estate market, and that's a long-term thing. But short-term, it's interesting to see that these have so much weight now. Like 2 weeks before this fall, September was quite active, and we had a number of pretty good listings that got multiple offers and sold in a week and had 20, 30 showings in that first week. But leading into the most recent announcement, I felt like the 2 weeks before that slowed down quite a bit. There wasn't as many people coming to see. Definitely people were more anxious or holding off on writing an offer, pulling the trigger. And it's something to, if you're thinking about selling this fall or next spring, it's something to take into consideration, like timing around an announcement now.
From a buyer, I've had multiple buyers say it's usually the buyer that's not urgent. That's the buyer that's opportunistic, that's very financially savvy, that's waiting to time the market perfectly. But I've had a number of buyers just say, we want to see what happens next week. Mm-hmm. And, next week being a rate announcement. Their price goes down if the rate goes up. If the rate holds, their price might still go down, or it depends on the feeling of the moment. But I've had sellers that have come out of the woodwork that want to list because they recognize that some people have rate holds that are lower and for a 5-year fix than they are today. So but arguably there's very few people transacting right now compared to before, and I think a lot of people that are transacting just have to move. They're well within their financial means. They want to upgrade on space or whatever it is. So they recognize that they get to shop with a little more time. They're taking advantage of it. And to those buyers right now that are out there, this is a great time. It might get a little worse before it gets better, but right now you have pretty good selection. Supply is up a bit, and you have a lot of time to negotiate. So the conversations of rates, I think it's more important to find the right property as a buyer and as a seller. If you don't have to list right now, wait. Don't expect November, December prices to get you to wow you. But going this whole game of waiting for the next rate announcement and deciding your list price or your offer price based on that announcement, it's getting a bit ridiculous. But I will agree with you that from a seller perspective, listing a property that is not turnkey, like the turnkey homes on the quiet streets, those are performing relatively well. But there's people that want yesterday's prices, or a price that's above market, or a home that needs renovation, or a home on a busy street. It has a negative. There's a lot of homes that have a negative. And for those ones, maybe if you need a little luck on your side to get your home sold, maybe don't list before the rate announcement. Maybe wait until after the rate announcement, because if you list a week before your rate announcement and you don't have many buyers to begin with, after that opening week, you might lose some offers because the buyer's waiting to see what happens in a few days. So that is the strange world we're in, where in some cases it makes sense to wait to list your property until after a rate announcement, or at least don't do it where you would plan to look at offers a day or two before the rate announcement.
Yeah. What do you see happening for the rest of the fall? We're coming off 2 rate holds. The next meeting is December 6th. What is the November, December market look like going into the new year?
Well, I mean, the rate that we're talking about, I mean, ultimately we're kind of talking about the prime rate because it relates to variable mortgages. And but there's different things to look at. There's what the 10-year bond yield is doing and how that affects fixed rates. Even though the prime is 7.2 right now, the prime rate in Canada is 7.2%. Fixed rate, which is high, and that's higher. What was it? I don't have my notes in front of me, but 6 months ago, I believe that's a little higher than it was 6 months ago. But 6 months ago, the fixed rates were considerably lower than they are today. So there's a couple moving parts here, but I think that the rates become an expert. I've become an expert on this, Denny. But I think there's. You listen to stuff. I think there could be another quarter bump at some point in the coming months. It could just hold. I think the damage is done. You just got to let it unfold.
Yeah.
So my hope is that they hold, and I hope that the damage will show its colors, because I don't think that soft landing is looking like it might be a little harder.
Yeah.
And it just needs time to kind of set. So my hope is that they'll just hold it, and the data will reflect that it's working. And my hope is by next year, maybe the second half, we start seeing that prime rate come down.
You mentioned supply or number of sales, and we're going to do another podcast, so check out that one too. But talking about specific neighborhoods and how they performed this September, October compared to 2022, compared to 2021, and the number of sales, and going from this September, October to 2021, September, October, the amount of sales is down more than 50% in a lot of locations, in a lot of different submarkets, whether that's single family in Maple Ridge or townhouses in Langley. More than 50%. This is super significant. Like, have we ever, in your 15-year career, have you ever seen sales volumes this low? Probably not. Maybe 2008?
Oh, that's a tough one.
Yeah.
There's been, I think this is when I look at, say, from last spring of 2020, when it started cooling off last year to today, that's kind of an extended period of time with lower transactions.
Yeah.
But there's definitely been soft seasons. I know that, I mean, in the past, some of those soft seasons have led to a hike in prices. Like, I can recall the fall of 2015 being low sales volume, but very low listing supply.
Yeah. And
that led to a screaming 2016 and 2017. I also remember 2018 and 2019 cooling off. And I remember the big crash of 2008. Like, there was a period there for a season where it was very slow and prices were on the drastic decline quickly. This one just feels different than the past. Mm-hmm. Rates are high at high prices, and that's a big difference. And and I think we're, in 2008, 2009, when we had that market crash, the world was falling much harder in other places compared to Vancouver. Like in the US, they were crashing for like a year or two, and Vancouver was in this Vancouver bubble, and you were waiting for it. And eventually it did happen, but it was like within a 12-month window. It went down and went up from, call it, August 2008 to the next August. It was a very quick rebound. Whereas other parts of the U.S., because they were lending with 0% down at inflated prices, and people were defaulting on their mortgage all over the place.
Yeah.
The U.S. was just in turmoil, and their market was getting devastated. But now it's different, because the U.S., a lot of the homeowners down there are locked into 30-year mortgages at 3% rates. So as long as they don't move, their job remains.
Yeah.
They're unaffected. If you have a locked-in 30-year mortgage at 3% or even below 4%, and your job is secure, you are living in a recessionary time or without being impacted at all. Mm-hmm. And that is very different than what was happening in the States, call it 14 years ago.
Yeah. I'd say the sentiment is definitely different than I've felt. There's definitely more anxiety. I mean, we talk to consumers about rates and renewing their mortgages all the time. And I think there's a lot more anxiety of like, what do I do now? I can't afford to double my mortgage payment per month. I'm coming up for renewal in 12 months. Like, how do I navigate this? What do I do? And the Financial Post put out an article last week, I believe, and the research was 3.4 million Canadians are going to be renewing their mortgage in the next 18 months. So by the end of 2025. And so, first of all, like, what does that look like? What are options for people? What does that do to supply potentially? What does that do to market values potentially? And it's a lot to unpack. There's a lot of guessing involved. But like recently they started talking about increasing amortizations to 40 years. They haven't said much details about that or when that would come into play, but like something like that potentially could come into play to ease consumers through this like renewal process. But
it's a lot of mortgage renewals happen. And there's it's when you get the headlines of it, 3.4 million and by 2025, and I think there's something, it's somewhere in the neighborhood of like 3/4 or 2/3 of mortgage renewals happening by then too. So it's a lot of people renewing. Right now, the defaults seem to be quite low. So we're not seeing a lot of defaults, like defaulted mortgages hitting the market as a distress sale. We're not seeing like those foreclosure sales. But when I think of 2024 in the year ahead, likely worst case scenario is these rates stay high, the sentiment's negative, there's not a lot of optimism in the future. More people have to sell because they can't afford to keep their places. Defaults pick up, and we're in a genuine, the market goes down, call it another 10% plus. That's likely worst case scenario. Likely best case scenario is our supply tightens up because people don't sell, and a low supply holds prices. So those that have to sell still have equity, they can get out, and minimal impact on prices. And it's just another slower year, like below the 10-year average in terms of sales volume.
Yeah.
All this slow period, it's been slow, call it since midway through last year. To me, it's just backlogged demand. Like it's going to show its colors in 2025 or 2026 in a roaring market. So when you have this high rate world to check inflation, it's going to cause the headlines in 2 or 3 years are going to be prices are up 20% a year and Vancouver's too expensive. And it's going to be a different type of frustration with a screaming market. So I think that we probably will see more distressed sales, but I don't see prices coming down significantly. Last November felt like the bottom of this little market. Maybe this November's prices get back to where last November was. I could see certain product types like land value, because builders are trigger shy right now, getting hit more. But a turnkey house on a quiet street, I don't see those coming off in value much when it costs so much to replace those structures, and it's more expensive to build a new home today than it was yesterday. So, yeah.
I was even a little bit surprised looking at some specific neighborhoods of the average and median price points of September, October this year compared to last year, compared to 2021. The numbers are not that different.
They're not.
So
we're going to get into that with our market
stay tuned for our next podcast, but
it might be the podcast before this one, Denny. It depends when we launch it. But we're doing a market update podcast today too. So if you haven't listened to it, scroll down, look for it.
Yeah, either go up or back one.
It's going to be before or after this. One thing I'll mention, the rate announcement was, primed, like it doesn't move. But one thing I'll mention that I was listening to in a podcast was 2008 had high rates as well. So in the summer of 2008, it was 5-year fixed. I can recall a client getting a 5-year fixed around 6%. I think they're higher today than they were at the peak of then by a little bit.
Yeah.
But there was a period there where there was 0 down 40-year amortizations. And then they tightened credit and reduced 40 years to 35. And then eventually, they just slowly increased the down payment, reduced the amortization. I believe from 2008 to today, there is over 160 policy changes that the government made when it comes to mortgages. So not just the fact that they reduced amortization and increased the down payment. There's all these other little things that we're not going to get into. But from my understanding, they have no interest on backtracking. There's talk about increasing amortization. The concern about increasing amortization is it's kind of inflationary in a way. When you give people, by increasing amortization, you're making payments lower, which allows people to lend more, which ultimately will increase prices. But there's ways to mitigate that. You can increase amortization, but make people qualify on a lower amortization. The dynamic that is different today is we're in the higher rates than we saw in 2008, with lower amortizations, larger down payments, less credit, more tightening. And back then that market was largely got there because of how loose it was. Mm-hmm. I had a client buy a place with 0% down. They put a deposit in an offer, and at closing they got a check back. Like it was crazy. It was, and those are signs of, yes, crash is coming. These are hard times in a different way. And I think there is a worst case scenario where this lingers longer than I'd like it to. And by longer than I'd like it to, I'd like to see optimism by late 2024. And if you asked me a year ago, I thought we were going to see it by today.
Yeah.
But the longer this delays, the more damage it's going to cause. And that's the concern I have. You get a lot of teachers, firemen, police officers, nurses. They have fixed incomes. They can't handle their variable mortgage payments doubling.
What do people do? What's their first conversation? What are solutions?
Well, some of the common things that we see that people that are in this spot to renew a mortgage, they're leaning towards more of a shorter term fixed. It might be a 2-year or 3-year fixed rate in the hopes that, yes, I'll pay a higher rate for 2 years, but I'll be setting myself up for a great renewal 2 years out, hopefully. So it's more about teeing yourself up for the future. I believe 5-year fixed rates are lower than 3-year fixed rates. There is the thought some people might be doing 5-year fixed. Variable leaves you flexible, but what are you seeing people do? I'm seeing more of the short-term fixed.
Yeah, the short-term fixed, if you look at the fixed rates over the last 12 months, right when interest rates started going up, bonds also started going up, and we saw 5-year fixed rates get into the 6s. And then this time last year, they actually came down quite a bit, and I was seeing high 4s for 5-year fixed, which are not there anymore. Yeah. And then back to today, a 5-year fix now is somewhere between 6 and 6.5%. And the 3-year fixed are not that much better because I think a lot of people had kind of gone into that product type. And sorry, they're not much worse. But we got a 3-year fixed on Whistler and it was 6.29 versus the 5-year fixed was 6.09 or something like that.
Yeah.
So it wasn't a significant difference. It's not a pretty environment right now, though.
No.
And my gut feeling is this is kind of the worst of it. And I do feel like the next few months could be, who knows? There might be 2 or 3 rate hikes next year and then pandemonium sets in. Who knows? But my gut feel is the Bank of Canada is understanding that anxiety is really high, and a lot of people are being very cautious about spending outside of their housing costs, and a lot of people are starting to reach out to people like us, realtors and mortgage brokers, asking what do I do? I can't afford to double my mortgage payment when it renews in 6 months. What do I do? And I think you're right. We will see a little bit more in terms of distressed sales, but I don't think it's going to increase supply enough to have this crash that people are talking about.
I think it would be good to talk a little bit about the yield curve too in this whole equation, because as realtors we become financial experts and we start paying attention to a yield curve. For some people that are reading these headlines, you might have heard the term inverted yield curve, and what that means is the 2-year bond yield is higher than the 10-year bond yield. And usually in most normal times, the 10-year is higher than the 2-year because you want to get rewarded, with higher interest for committing to a longer term. But that's not the case right now. So, and usually when it's an inverted yield curve in the I think right now the 2-year yield is 4.7 and the 10-year yield is around just over 4. So it's a little bit of a spread. It's a sign of recessionary times is what it is. It's a sign that, there's it's a sign towards recessionary times. But what we want to look at is if the bank announcements are hold rates for the next 6 months, what we would really like to see is that 10-year yield curve come down. And right now it's a hair over 4. A couple of years ago, I think 2020, it was under 1. So it's gone up. And if that yield curve comes down and the fixed rates will follow, we don't need if the prime is 7.2 in March, but that yield curve say comes down to 3, which I don't know if that's even, what the odds of that would be. If the fixed rates come down, market optimism will go up.
Yeah.
The variable mortgage payers will still be stuck, but there'll be hopefully better alternatives for them to get out of it. There'll be more market optimism. I can't believe that a 5-year, like a 5% fixed rate sounds good, but that's the world we're in. Mm-hmm. When we get back to the fixed rate being at 5%, I think there's going to be a lot more optimism out there.
What do you think this does for like consumer decisions and risk tolerance moving forward in terms of, because I believe right now that Financial Post article said roughly 20% of Canadians are in variable mortgages. Does that consumer that goes variable go down in the next like 2 to 5 years? Is that number that's 20% of Canadians? Does that go down to 5% of Canadians are in variable rate
I think
mortgages?
A lot of people are going to react to this. And I ultimately think it will probably be the bad decision of the time.
Yeah.
When you come out, we're all getting hurt now.
Mm-hmm.
So, a lot of human mindset is variable is no longer good. I'm not doing variable anymore because this variable screwed me. And then you switch to a fixed in 2 years or the next cycle. And that's the time that you probably should have been variable. So, variable normally wins out over fixed, but we're in a time where that's not the case. Mm-hmm. And I would say that I think more people are going to value peace of mind. So that's a good reason to have a fixed payment. You know what you're going to get. But arguably after we get out of this is the time that you would benefit from a variable over a fixed. But that's just, that's a broad thing. I mean, it depends. Like I wouldn't say the same if you're renewing tomorrow, but I'm talking about maybe it's in a year or 2 from now. Mm-hmm. Yeah. Tomorrow I'd probably lean towards a short-term fixed rate myself.
Yeah.
Yeah.
Most years we see variable slightly below like a 3 and 5 year fixed rate. This year is, I can't be super confident saying this, but I believe it's the first time I've seen variable like quite a bit higher than fixed rates. And I don't know if that continues. I don't know, but it's interesting to see how much different they are. Even like look at last fall, early 2023, the variable prime was like 6.95-ish, 6 somewhere in that range, 6.45 to 6.95, and variable rates were not discounting much. It was like -0.1, -0.2. Mm-hmm. So you're paying 6.3, 6.4 for variable rate versus 5-year fixed rates at the time were mid 5s. So it was like 1% or more difference. And usually we see it the opposite way, right?
Yeah. Yeah, it's everything's backwards right now. Yeah. We're in bizarro world. Yeah. I think for a lot of what is the advice that you're telling people to do right now? I mean, we're having these renewal conversations. We're having a conversation with people that, well, one concerned about renew, but 2 probably want to move and do something different. So I guess what I'm getting at is there's a lot. Don't wait until you decide that you're going to sell to start fixing up what's wrong with your home. Like right now is a time to improve your home. Right now, if you're not selling your home right now, start improving it so that when you sell it next year or the year after, you get more money for it.
Yeah.
Because I could see a scenario, even though it's high rate environment, it's hard to justify the costs of a reno right now. I think when we get out of this, the cost of renos are going to go up more than the interest rate we're paying today. So if if you're not doing $100,000 reno because you're worried about paying 7% on it, I think that 2 years from now, that $100,000 reno might be $120,000. And yes, your rate might be 3 or 4%, but you're spending a lot more to get the reno done because trades are going to be in much more demand.
Totally.
So right now, even though this is not about a rate announcement, right now, if you're feeling stuck, add value to your home. Fix what's broken, make it more presentable so that you're more liquid if you do actually get in a pinch and have to make a move quick. And then separately from that, we hope you can ride out this storm. Mm-hmm. And if you have to sell, rarely do we suggest, unless you have teed up a really good buy, we're talking in Halloween. This is Halloween. November's right around the corner, December. Usually the advice we give to most is if you're going to list a property and we're talking in November, December, you might as well wait till January. In most years, January, February is better than November, December.
Yeah.
This year might be different, but right now it doesn't feel, except for the turnkey properties, it doesn't feel like a good time for most people to list their home.
Yeah. I think the reality with the rates and renewals coming up is a lot of people will be considering selling their home. And so even what Jamie said, if you don't have a ton of cash to put into a reno to update your kitchen or new appliances, small things make a really big difference in terms of first impression, such as paint, such as like cabinet handles.
Yeah.
Like those are not super expensive, but updating
outlet
them,
covers,
totally,
door handles,
yeah,
you name it, landscape. Yeah.
A lot of it is just effort. And if you are thinking about selling your home, that could be the difference of getting an extra $10,000 or $20,000.
Absolutely.